It's a pleasure to be here at one of China's leading business schools, and especially I want to give a strong thank you to Wall Street CN for organizing this event and introducing me and my ideas to you. It's a great pleasure. What makes an outstanding investor? Most people believe it's high returns, but I think that's not enough. It's easy to make money in the market, especially in the good years, and most of the years are good years. So merely making money is not enough, in my opinion. I believe that the outstanding investor makes money in the good years with the risk under control, so that if a year turns out to be bad instead, his losses are not too great. High returns earned with risk under control is the mark of an investor who is excellent. Number two, what are the jobs of the investor? What is it that we do for a living? And I believe that there are two activities that investors engage in, and everything that we do falls under those two headings. The first is asset selection, and the second is cyclical positioning. Asset selection means simply owning more of the things that do better and less of the things that do worse. And cycle positioning means having more invested more aggressively at the right time and less invested more defensively when the times are less good. Everything we do, in my opinion, falls under one of those two headings. What I'm here to talk to you about tonight is cycle positioning and how we can accomplish it. As you know, I have a new book out. It's called Mastering the Market Cycle, and it's about how we can interpret cycles and understand cycles to put them to our use so that we can profit from them rather than be victimized by them. The subtitle of the book is extremely important, as you'll see from my discussion, Getting the Odds on Our Side. We never know what the future holds. Even the best investor does not know what the future holds for sure. The best investor makes investments that have a high probability of a good return and a low probability of a poor return or a loss. To do that, he positions his portfolio correctly. He doesn't know what's going to happen, but he can get the odds on his side. That's what I'm here to talk to you about tonight. We do that by understanding cycles. So here we are. What is a cycle? Now, most people would say that a cycle is a pattern of up and down oscillations around a central trend. That central trend might be called the average, the mean, the norm, intrinsic value, the secular growth rate, whatever it might be. But clearly, we don't merely see progress at that rate, we see fluctuation around that rate. Sometimes the market goes faster, sometimes it falls back to earth. So up and down fluctuations around a midpoint. Most people would say that a cycle is a progression of events that follows a normal pattern. A followed by B, followed by C. I think that in order to have a superior understanding of cycles and to be able to do the best with them, it's better to think of a cycle as a progression of events where A causes B and B causes C. And if you can understand this, the nature of this causal relationship, I think you can do even better. There is a causal relationship, for example, between the issuance of high-yield bonds and the incidence of difficulty in the market. I've watched this. I've been involved with high-yield bonds for 41 years. I've seen this cycle play out several times, and it takes a standard pattern as follows. Risk-averse investors limit the quantities of bonds that can be issued and demand high quality. High-quality issuance leads to low default rates. Low default rates cause investors to become complacent and lazy and risk-tolerant. Risk tolerance opens investors to increased issuance and lower quality. Lower quality issuance eventually is tested by economic difficulty and leads to increased defaults. Increased defaults have a chilling effect, resurrecting investors' risk aversion. This is a standard pattern. I think it is accurately described in this description. But how many people in the audience have caught on to the fact that at each line of the description, the last few words are the first words of the next line? That is the process through which events cause the events that follow them. And I hope that you will catch on to the nature of this causal relationship and look for it when you witness patterns in the future. Now, I've been investing, as Rachel said, for over 50 years. And I have witnessed a number of cycles. I've tried to understand those cycles, to understand where they came from and what the effect was. I believe in cycles, and I believe we always will have cycles. So I'm a devotee of cycles. And yet, when I was writing this book, and I got about 2/3 of the way through, a thought crossed my mind. Why do we have cycles? For example, U.S. GDP grows on average about 2% a year. Why doesn't it just grow 2% every year? Why sometimes 3 and sometimes 1, and sometimes 4 and sometimes negative in a recession? Why not 2 every year? Similarly, the S&P 500 index of stocks in America returns historically almost 10% a year on average, but it doesn't return 10 every year. And in fact, if you look at the data, rarely is the return on the S&P 500 between 8 and 12. So 10 may be the average, but it certainly is not the norm. And most years, it's considerably higher or considerably lower. Why not 10 every year? Why do these phenomena move in cycles? And the answer, in my opinion, is very simple. Most positive trends eventually will be carried to excess, and when they go to excess, they will require correction. So I think of cycles as excess and correction, not just ups and downs, but excesses and corrections. And I think if you think that way, you'll have a better time understanding the essence of cycles. Why do trends go to excess? And the answer, in my opinion, is simple: because of the involvement of people. We have a famous physicist by the name of Richard Feynman, and he said physics would be much more difficult if electrons had feelings. The point is that electrons don't have feelings, and so they always do what they're expected to do. You walk in a room, you throw the light switch, the lights go on every time. And that's because the electrons flow from the switch in the direction of the lights. They never decide to go backwards. They never go on strike. They never forget to travel as they're expected to. They can be relied on to act as they should, and as a consequence, physics is understandable. But it is people who make up economies and markets and companies, and people have feelings. And so their behavior is not dependable, it is inconsistent. So why do trends go to excess? The answer, for example, is that you may have a company and the management may turn optimistic. They may feel that in the coming years there's going to be a great demand for their product. So they build new factories, they hire new workers, they produce goods for inventory so that they'll be ready to meet the future demand. And the period in which they and perhaps their competitors all build more factories and produce for inventory is considered a period of above average growth. That's how we get excesses in economies. Likewise, in the stock market, positive investor psychology can cause asset prices to rise faster than the growth rate underlying the fundamentals of the company. And when we have appreciation of securities in excess of the long-term trend line of the company's growth, that produces a period called excess or above average appreciation. And this, of course, leads eventually to historically high valuations. But what happens when these excesses are corrected? Sometimes, after a period of expansion of an industry, it turns out that the demand does not materialize. And so the management closes factories, lays off workers, sells from inventory, cuts back on production. That's a period of below average growth. Excess, correction. Likewise, in the stock market, in a period of optimism, the price rises faster than the underlying trend line. Eventually, it reaches a level which is too high and unsustainable, and the price moves back in the direction of normalcy, or through it, excess and correction. So, causality, excess, and correction. Now, another important question: are cycles dependable? And I think the key to understanding the question of whether cycles are dependable in economies and markets goes to a quotation from the American humorist and author Mark Twain, who said, "History does not repeat itself, but it does rhyme." Nowadays, people say to me, what about the current cycle? What cycle from the past is this the same as? And the answer is there is no cycle in history exactly like this cycle. There are similarities, but there are also differences. Every cycle is different from the others in terms of the amplitude of fluctuations, the duration of the fluctuations, and the speed of the fluctuations. They're all different. History does not repeat. Similarly, there are differences in the causes of cycles and the effects of cycles. Never are they the same. But there are certain underlying trends that do tend to repeat. There are trends, as Mark Twain would say, that rhyme from one cycle to the next. For example, what are the trends or themes in a bull market that tend to recur? I've lived through about a half a dozen significant bull markets in my 50 years of experience, and as far as I can see, most of them have been characterized by an excess of optimism, a shortage of risk aversion, and an excess of capital availability. Let's take those three themes together. And by the way, if you think about those three themes, number one, together they constitute a pretty good recipe for a bull market. And number two, without them, I think it would be very hard to have a bull market. So if we can understand that the recurring themes are optimism, shortage of risk aversion, heavy capital availability, then maybe we can recognize bull markets when they form and lighten up our positions so that we don't succumb when they decline. Let's talk about these three things one at a time. Role of optimism. The common man believes that security prices, stock prices, fluctuate in response to changes in events. If company profits are high, the stock will go up. If company profits are poor, the stock will go down. We call events in our business fundamentals. And many people believe that stock prices fluctuate in response to fundamental developments. That's true, but it's not complete. Because in addition to fluctuating in response to fundamental events, stock prices are influenced by emotion, psychology, optimism. The more optimism there is baked into the price of a security, the more likely it is that its price will be high relative to its intrinsic value, that it will be priced at an excessive high price. If instead the prevalent feeling is one of pessimism, there's a higher probability that the price will be below the intrinsic value, that is, that it'll be a bargain. So one of the things we want to know very strongly is how much optimism is included in the price of that asset. It's very important that we gauge the level of optimism. Number two, risk aversion. Risk aversion is a very important concept. It is not a concept that most people are familiar with, but they should be, especially if they are in the business world and in particular the investment world. What risk aversion means is very simple. People don't like to lose money. And most people are averse to risks. They fear losing money. 100 renminbi lost means more to most people than 100 renminbi gained. Most people are very sensitive to losses, not so sensitive to gains. That describes the average person who is risk averse. Because people are risk averse, they will tend to do thorough due diligence before they make an investment, take a skeptical approach in doing their research, incorporate conservative assumptions, insist on a margin of safety so that they'll be okay even if things go wrong, and insist on a risk premium so that investments that appear to be riskier will appear to offer higher returns. If you think about it, it wouldn't make any sense for people to make a riskier investment if there was not the hope of a superior return. And the margin of that superiority is what we call a risk premium. That describes a market when people are appropriately risk averse. But remember Feynman's electrons. People don't always act as they should. They should always embody a reasonable degree of risk aversion, but sometimes they forget to be risk averse, and sometimes they become excessively risk averse. When people are excessively risk averse, they won't touch a risky security regardless of how high the potential reward is. That's a form of error. Just in the same way, when people become inadequately risk averse, they stop demanding high returns to take risk, and they buy risky securities without enough potential reward. We want to know that. We want to know when people are inadequately risk averse and as a consequence are paying up too much for risky securities. Third, the impact of capital availability. The securities markets are an auction place. In an auction, the item which is up for sale goes to the highest bidder. The item which is up for sale goes to the person who will pay the most money, which is to say, the person who will accept the least for his money. Everybody knows that in an auction, the goods go to the highest bidder. But sometimes, when the people in the crowd have too much money and they're too eager to get rid of their money, to invest their money, or to put their money to work, then the bidding goes too high. And when an asset is up for auction and the price goes too high, what happens? The potential return on that investment comes down, and the risk involved in that investment goes up. So we get sometimes in the capital and financial markets to a condition that I call the 7 worst words in the world. And what are the 7 worst words? Too much money chasing too few deals. And when too much money chases too few deals is when the auction gets crazy, the prices go too high, and negative consequences ensue. So we want to know when there is excessive capital availability, inadequate risk aversion, excessive optimism. These things are signs of a bull market, which is an indicator of prices which are excessive and eventually unsustainable. So this is an example about how themes can repeat, and if you study cycles and you understand which themes connote which events, you can deal with cycles. Now, I want to put it together for you, and I want to take you through the development of a typical market cycle. There are many things which occur in different cycles, in the economic cycle, the profit cycle, the psychological cycle, the capital cycle, and the cycle in attitudes towards risk. They occur at the same time, they mingle together, and this is, in my opinion, the result. So, we start off at a low point. Perhaps there's been a crisis or a crash or a bear market. Prices, economic events have been depressed. But eventually we get on the way up. And in the way up, economic fundamentals improve, company profits increase and beat expectations, and usually the media, since things are going well, report only good news. And when this happens, expectations rise on the part of investors, psychology gets stronger, people perceive only favorable developments, capital becomes readily available for investment, asset prices rise, people who have been holding assets feel good about themselves and want to buy more, people who have not been holding assets feel regret. They've had to look on as others made money, they begin to buy, and risk aversion evaporates. And when things go well, what do people say? What they say is, the more risk I take, the more money I'll make, and by the way, I don't see anything to worry about, so I don't hesitate to make risky investments. And when all of these things on this list occur, and they usually occur at the same time, eventually the market rises to what we call a top, the maximum that will be attained the day that the last person turns optimistic, and the last person who hasn't bought begins to buy. At the top, asset prices are too high, prospective returns are too low, and risk is high. This is the time for caution when markets are at their top. But most people are euphoric Most people are having a great time. Most people are celebrating their gains and expecting more. By definition, the top in prices coincides with the top in psychology. So even though this is the time for caution, no one is willing to pull out of the market and take the risk of missing further gains. And by the way, in every bull market, eventually there's a point where what Americans call FOMO, fear of missing out, takes over from the fear of losing money. And clearly, when that happens, markets become precarious. That's a top. Now, things don't stay at the top forever. Eventually, they turn down. And on the way down, economic fundamentals are deteriorating. Company earnings are declining and coming in short of expectations, causing disappointment. And the media now report only bad news. And when this happens, investor expectations decline, psychology weakens, people see only undesirable developments, asset prices decline, holders feel bad and sell, non-holders congratulate themselves on being so wise and refuse to buy, and risk aversion increases. Instead of saying risk is my friend, the more risk I take, the more money I'll make, what do people say? They say bearing risk is just another way to lose money. I don't care if I ever make a penny in the market again. I just don't want to lose any more. Get me out at any price. And so eventually we reach a bottom. And at the bottom, asset prices are low, prospective returns are high, risk is low, because at the bottom there is very little risk of further losses, although it feels like there could be. Now, this is the time for aggressiveness. But most people are terrified and can't move ahead. No one wants to commit capital under these circumstances. Why? Because prices reach bottom just at the time when people are the most depressed and consequently the most cautious. So it's essential to understand what's going on in the various cycles to try to take advantage. Now, as I said at the beginning, the subtitle of the book is Getting the Odds on Your Side. And I hope you will think about that concept. And if you don't take anything else away from tonight, I hope you will take away the concept of getting the odds on your side. The market, in my opinion, in my view, the market is a lottery. There's a bowl, and the bowl contains a large number of tickets, and each ticket is a possible outcome. Of the tickets in the bowl, of the possible outcomes, many different ones can be drawn, but only one will be drawn. That's the way a lottery works. From the full range of outcomes, one outcome materializes. Now, in my opinion, assets which are priced below their intrinsic value, that is to say bargains, are potential winning tickets. Assets which are priced above intrinsic value, that is to say excessively high, those are potential losing tickets. And in the bowl, there will be potential winners and potential losers. Which ticket is chosen, that is to say which of the many outcomes will occur, is influenced by the merits of the situation, the fundamentals of economics and profits, but also by emotion and by randomness. And of course, there's a lot of luck in investing. The important thing to bear in mind is that we never know enough about the future to be sure which outcome will be chosen from the bowl. That is to say, we can have a sense for when the tickets in the bowl tilt the odds in our favor. We can't be sure what the outcome is, but we can, by studying the fundamentals and prices, we can have a sense for when good outcomes are more likely than bad, or for when bad outcomes are more likely than good. This is what determines when the odds are in our favor or against us. And what determines the mix of tickets in the bowl, what determines the odds of investment success in the coming months and years? In large part, the position of the market in its cycle. And in short, when the market is high in its cycle, the odds are against us. When the market is low in its cycle, the odds are in our favor. When are the odds against you? What causes the losing tickets to outnumber the winning tickets in the bowl? And in my opinion, there are things like this: a high-level investor optimism, as I discussed, investors who are spurred on by greed, recent successes, because what makes people more optimistic and greedy than having made money recently? Investors who are happy with their gains or jealous of the gains of others, and jealousy is one of the strongest forces all around the world. Unwise risk tolerance and eagerness to supply capital. Things like this denote a market which is elevated and a market which is against you. And when are these things seen? At market highs. When the cycle reaches its high, the probability is that these things have occurred and that the odds are against you. But when are the odds in your favor? What causes winning tickets to outnumber the losing tickets in the bowl? In my opinion, a shortage of optimism, a high level of fear, poor recent market performance, widespread losses, excess risk aversion, and a reluctance to supply capital. And when are these things seen? At market lows. So if we can focus on cycles, if we can understand where we are in the cycle, we can get the odds on our side. As I say, we never know what the future holds. One of the important tenets of my investment approach is that I don't believe in forecasts. Now, if you follow the news, the media, the papers, the TV, you'll hear lots of opinions. People who will say that the economy is strengthening or weakening, people who will say that the market will go up or down. I hear these forecasts too, but I don't believe them. Because I don't know virtually anybody who has been a highly successful investor by repeatedly being successful with what are called macro forecasts. Forecasts regarding economies, markets, currencies, interest rates. These are considered macro subjects, big picture subjects. Very few people get these things consistently right, and more right than others. How do you make money? In my opinion, by studying the micro, the little things where you can get an edge. And I think that by studying companies and industries and securities, it's possible to know more than the other. But I do not think we can do it by predicting the future. I don't believe in forecasts, especially my own. We never know where we're going, but hopefully we can figure out where we are and understand what that implies for the odds. So what everybody wants to know, where are we? I'm sure that half of you came here tonight to hear me tell you where we are. And to use a baseball terminology, I believe we're in the 8th inning. Now, that's pretty close to the end, and you might take that as cautionary advice. There's only one problem. I've been saying 8th inning for a few years now, and the game hasn't ended. I realized a year or so ago that in baseball, a standard game consists of 9 innings. So if somebody says we're in the 8th, And if they would be correct, that would mean that the game is about to end. And of course, if the bull market is about to end, we want to start reducing our risk and taking our chips off the table. The problem is that this is not baseball. And in investing, there is no fixed number of innings. So even if we were in the 8th inning, even if I was correct in that statement, the game could go 9 or 11 or 14. So we never know for sure when the game will end. Now, if you look at this graph, what I show here is a market which is somewhat above the intrinsic value. The intrinsic value is that slanted line running through it. The cycle fluctuates around it. And right now, in my judgment, the market is a little bit above the intrinsic value. The challenge in investing is that from any point in the cycle, as I indicate with the dotted lines, the market can go up or go flat or go down. The fact that something is overpriced, as I believe that this market is somewhat, not terribly, but somewhat, the fact that something is overpriced does not mean that it's going to go down tomorrow or next year. The linkages are not so firm as to be able to make that judgment. And of course, as you can see, well, you can't see it, there we are. As you can see, in the last cycle, when we were at the same point, which was here, if you concluded that the fact that it was overpriced meant that it was going down, you would have missed the move from overpriced to more overpriced and from more overpriced to the top. So the fact that we're here now, if that's correct, doesn't mean the next movement is down. Sometime the movement from overpriced is further up. So the important thing to remember is that from any point in the cycle, we can have further gains or flat or decline. Does that mean that we are helpless in figuring out what the future holds? Does that mean that understanding the cycle cannot help us to understand how to position our portfolios? The answer is no. Even though the position of the market in its cycle does not tell us what's going to happen tomorrow, it does tell us something about the odds. Because when the price is above the intrinsic value, while it's possible for the market to go up or flat or down, all three are not equally likely. When we're priced on the high side, declines or poor returns are more likely than further gains. You don't know from understanding the cycle what's going to happen tomorrow, but you can know a lot about the odds, and in investing, that's a great help and about all we can do. So study cycles, understand patterns, understand causality, understand repeating themes, understand human behavior, and I think that mastering the market cycle can help you improve your investment results. That's what I came to tell you tonight, and I hope it will prove helpful to you. Thank you.